Aloha, I'm Joanna Amberger with 3 Financial Group. Have you ever heard somebody say you can't go wrong with real estate? Many people feel that it's a better and a safer investment than stocks. Now, while real estate can be a good addition to your portfolio, it doesn't come without risks. I think one reason people feel that real estate investing is safer is because of the availability of price information. With the stock market, we can see price movements every second when the market is open. Each share of a company's stock is the same as every other, and there's an active market of buyers and sellers. This lets you know precisely what your shares are worth at any given moment. With real estate, we don't really know the price of a specific property unless we get an appraisal. Even then, the appraisal is just a guess. The only true way to determine the value of property is to put it on the market and see what kind of offers you get. The other reason many people prefer real estate over stocks is because they feel they can understand it better. Real estate's a physical thing that we see and we live in every day, and we can touch it. So we're automatically more comfortable with it. Stocks are abstract. Back in the day, you did get a stock certificate representing ownership interest in a company. Now, stocks are just numbers on a screen or a statement. There's a big separation between the representation of your ownership in a company through a stock and the actual company. These differences are not based on facts or data, but they're just based on emotions. For the most part, people will make an emotional decision based on how the information is packaged. So let's compare a hot real estate market, like single-family homes on the island of Oahu in the state of Hawaii, my hometown, to the stock market as represented by the S&P 500 index. So if we look at the data, we see that if we purchased a median value home back in 1986, we would have paid about $170,000 for it. And if we held on to that home until the end of 2021, we could have sold that median value home for about $990,000. Now that turns out to be an annual average gain of a little over 5% on our investment. Our investment value went up over $800,000, and all we had to do was sit on it. Now, of course, when we're sitting on that house, we still have to repair the roof, replace the appliances, and fix the leaky plumbing, but that's besides the point. Now, if instead of buying a house, we had invested our $170,000 into the companies of the S&P 500 index, the value of our investment portfolio would have been valued at over $3.3 million at the end of 2021. Our investment value went up over $3 million, and all we had to do was sit on it. Now, neither of these investments had positive returns every single year, but when we look at the data, we see that real estate actually experienced more years where the prices went down than our stock investment in the S&P 500 index. However, the stock market was more volatile. It went up and down more during that same time period, with larger ups and larger downs. The stock market had nearly double the volatility of real estate. But be clear, real estate did experience downturns. These downturns are less noticeable for 2 reasons. First, you don't know the minute-by-minute price of your house. Second, you likely didn't sell your house and lock in those losses when the real estate market went down. However, average stock investors most likely would have panicked and sold their investments. Unfortunately, by reacting emotionally, that average investor tends to shoot themselves in the foot, and they erode the value of their investments over time. Now, I would like to acknowledge some limitations on this comparison I've made so far. I am simplifying the analysis to just do a price comparison here. One of the unique values of real estate is you can leverage your investment by using debt, aka other people's money, to control that real estate with a smaller cash outlay. You can, of course, also buy stocks on margin, which might be comparable. When you leverage your investment to get higher returns, whether it is real estate or stocks, you also leverage or increase your risk. Nothing comes for free. Real estate also gives you the option to generate income by renting out the property, and that rent can also pay that mortgage or the debt. However, ownership in companies also comes with dividends, which are the profits the companies return to their shareholders or their owners. And finally, I'm using median values when looking at real property. Some of you are going to say, what about my house in Kailua or Manoa or Portlock? I know. As they say in real estate, location, location, location. One of the risks of real estate is the specific market in which you buy. Neighborhoods change, hidden defects emerge. However, the same is true in buying companies. Now, my point here is not to say that real estate is bad. My point is that every investment has advantages and disadvantages, risks and benefits. You should assess those risks and benefits with data, not based on flawed emotional reasoning. Also, pay attention to how you are consuming information. That makes a difference. Now, working with a certified financial planner can be a great way to develop a plan before the market goes sideways, and they can also help you stick to that plan and check your emotional reactions. Reach out to us today for help with your plan.